Kevin Prendergast, Director of Wealth Management at the Retirement Network, Leland Smith. I'm recording this video on Monday, June 19th, 2023. I'm going to share my screen and we'll get into the May 2023 minimum present value segment rates recently published by the IRS. All right. As always, these segment rates are most relevant if you are preferring a pension lump sum, not a monthly annuity, but a pension lump sum. And if after watching this video you have questions, you'd like to schedule a conversation with one of our advisors, click the Get Your Free Assessment button or reply to the email containing this video. We do monitor that inbox. Let's take a look at the May rates. See, they've ticked back up from April, approaching the levels of last November. So generally speaking, if you commence a pension lump sum in 2023 calendar year, that lump sum will be calculated using the rates you see highlighted on the screen. So November 22 rates. Exception is if you are in one of the pension programs that doesn't use these rates, most of them do, or if you are over the age of 65, you turn 65 in a prior year, your rates may have been locked in at that time. Okay, so those are some of the exceptions. You can see we tick down a little bit in the first segment, so 4.91 compared to 5.09. 5.15 compared to 5.6 and 5.34 compared to 5.41, but trending back up relative to April. Okay, so lower is generally better in the context of this conversation. I know a lot of folks who are not in the kind of key cities that identified by AT&T might be looking at some kind of headcount reduction or relocation. For example, our firm is based in Chicagoland, so I know a lot of the rumors might affect folks based in Chicagoland. So if you will be leaving the company in the near future here, and think you'll have more information in a couple weeks, just know that you don't have to commence your lump sum right away. You don't have to commence your lump sum right away. If you want to kind of play the interest rate game, see if rates trend back down over the rest of the year, you can wait. Of course, you want to be very vigilant. You want to monitor that dynamic closely. Think through all the trade-offs, et cetera. So that's not a decision to be made lightly, but it is an option if you will be off payroll in the not too distant future and you have a preference for the lump sum. You want to see what the rest of the year holds in terms of interest rates. The risk perhaps is that if you were to pass away prior to commencing the lump sum, the death benefit is usually not a good outcome. So that's kind of the primary risk to playing that interest rate game, but you know that is an option at your disposal. You can leave the company, retire from the company, and then wait, see if interest rates come back down. All right, see you next month. Bye.